Chapter 4 covers accounting for merchandising operations. So up until this point, we've talked primarily about service businesses. These businesses, merchandising businesses, retailers, wholesalers, they actually have inventory. Up to this point, we haven't looked at accounting for inventory. So this is what we'll learn in Chapter 4. The operating cycle, as you can see in the image there, is the process where a company spends money, generates revenue, and then receives cash, and that might be at the time that the product is sold, or it could be as an account receivable and the cash is collected later. So the operating cycle of a service business, like we've talked about before, is different than a merchandising business. So with a merchandising business, as I mentioned, there is inventory. So the business has to purchase inventory in order to then sell it and make revenue. Financial statements are also different between service companies and merchandising companies. So we looked at financial statements before with a service business, and primarily you're just looking at revenues minus expenses equals net income on your income statement. It's different for a merchandising business because they also have to account for the inventory that they purchased and the cost of that inventory to them when they sell it within the income statement. Ultimately, you're still going to be arriving at net income, but for a merchandising company, there's just a little bit longer of a formula to get there. A couple other differences with a service business. Typically, you're looking at a revenue account called fees earned, whereas with a merchandising business, the revenue account will be called sales. So a little bit more about the income statement, and then also we'll talk about the balance sheet as well and how they differ between service businesses and merchandising businesses. So one of the primary differences is that with a merchandising business, when they record their sales in the income statement, they also have to record the cost of those sales. So we call that cost of merchandise sold or cost of goods sold. And you'll see the formula for the income statement in just a minute. But one thing that is a little bit difficult to understand has to do with the matching principle. Remember, previously we talked about the matching principle and how GAAP says that we have to match expenses to revenues. So when a company sells 4 items, for instance, then at that point on their income statement, they will have the sales price for those 4 items in revenue, and then in expenses, they will have the cost that they incurred when they purchased those 4 items to put in their inventory. So we report that as the cost of merchandise sold. So in the revenue portion, we have the amount, the total that the company received when they sold the merchandise. Then reported in the expenses is cost of goods sold. And when you subtract revenue minus cost of goods sold or cost of merchandise sold, that will give you your gross profit. So here you can actually see the difference between a service business and a merchandising business. So in previous chapters when we talked about a service business, as you can see, we just looked at essentially revenue minus expenses equals net income. So fees earned being the revenue account minus operating expenses gives you net income. With a merchandising business, as you can see, like I mentioned, there are a few more steps in there to calculate net income. So you begin with sales, and that is going to be the total amount that you received for selling the inventory. Then you subtract out cost of merchandise sold to get your gross profit. That's the first step. So sales is calculated based on the sales price times the number of items. Cost of merchandise sold is based on the cost to the company when they initially purchased that inventory. So that's the cost times the number of items. And essentially what that will give you is profit. We know that profit is that extra money that you get on top of what you paid for an item. So you pay for an item, then you resell that. So the profit will be the extra money that you got on top of what you initially paid for it. So that's gross profit. At that point in the income statement for a merchandising business is when you subtract out operating expenses. Operating expenses are expenses that we've seen in previous chapters. So utilities, phone expense, anything like that that you incur essentially for being able to operate the business are those operating expenses. And then finally, that brings you to net income. Here are a few exercises. The answers are already here for you, but I can explain how we arrive at those answers. So determine whether each of the following characteristics relates to a merchandising or service business. A, at year end, the company holds merchandise inventory that was not sold during the year. So if there is a company that is purchasing and selling inventory, we know that that has to be a merchandising business. B, the company's financial statements do not list cost of merchandise. We know that that is a service business because they just look at revenue minus operating expenses to get to net income. There is no cost of merchandise with a service business because they provide a service, not merchandise. C, the company's largest current asset is inventory that is listed on the company's balance sheet. So, if the company has inventory on their balance sheet, then it has to be a merchandising business because a merchandising business purchases and sells inventory. The same for the next three. Peter's Paralegal's revenue consists of mainly revenue from providing advice to clients, which is billed at an hourly rate. He's providing a service by providing advice, so that is a service business. Crawford Insurance Company provides health and home insurance for clients, which is billed at a monthly rate. Again, that is providing a service. C, Fire Armor has a high inventory turnover for the year for its no spark fire strips. If there is inventory, then that indicates that it is a merchandising business. Now, in terms of calculating net income for a service business versus a merchandising business, remember we have our formulas that we have to follow for constructing an income statement and calculating all the different things that we find on the income statement for a service business versus a merchandising business. So first, Jeff's Bikes had sales on account of $3,900 and cash sales of $1,200. If the company's cost of the merchandise was $1,100, what is the company's gross profit? We figure that out by looking at the formula for a merchandising business. Because if there are sales and merchandise, that means that it's a merchandising business. So we will primarily be looking at the first three steps of this formula because the question is asking us to calculate gross profit. So if you look at the formula, you can see that sales minus cost of merchandise sold. This can also be called cost of goods sold. So sometimes you'll see it abbreviated COGS, cost of goods sold. So sales minus cost of merchandise or cost of goods sold gives you gross profit. So if we're looking at our problem, instead of giving us total sales, they gave us sales on account and cash sales. So we have to add those two numbers together to get total sales, and that is $5,100. So that is the amount that the company received when they sold the merchandise. That's what sales represents when the goods are sold. The cost of merchandise sold, or the cost of goods sold, is exactly what it sounds like. That's the cost initially that the business purchased the inventory for. And so that is $1,100. Back when they purchased it, it cost them $1,100. So cost of goods sold, $1,100. Subtract that out, and that gives you a gross profit of $4,000. Next, a company had a gross profit of $4,500. So this time they're already telling us the gross profit. If the cost of merchandise was $2,150, what were the company's total sales? So this time they give us gross profit, they give us cost of merchandise sold. We have to calculate sales. So what that means is we're still going to use that same basic formula. We just have sales as our unknown. So what we can do is look at what we know. We know that cost of goods sold is $2,150. We know that gross profit is $4,500. So we have to figure out what the sales amount is. The way that we do that, obviously, is to see what belongs there with sales to add together with $2,150 to equal $4,500. And so that amount of sales is $6,650. So if we have $6,650 here, then that completes the subtraction problem. And we see that we have $6,650 in sales. Then Torty Company had cash sales of $2,760 and sales on account of $8,200. The company's gross profit at the end of the year totaled $5,590. What was the cost of the merchandise? So again, we have those first three steps that we're looking at in the gross profit calculation. This time they give us sales and they give us gross profit. So we have to figure out what the cost of goods sold is. So again, they give us cash sales and sales on account, which have to be added together to get the total amount of sales, which is $10,960. And the problem tells us that the gross profit is $5,590. So then we essentially have to figure out what is missing. That goes here. And that amount is $5,370 for the cost of merchandise or the cost of goods sold.